$1,000, same amount, same day, same belief in the ISO 20022 infrastructure thesis. One goes into XRP, one goes into XLM. Which one gives you more gains per dollar? Not which one is a better asset. Not which one has better technology or more institutional validation or a cleaner regulatory story. Which one gives you more gains per dollar from exactly where both assets sit as of the time of recording? That is the question. And the answer is not the one most people in this community would give if you ask them right now. Because the answer requires doing the actual math. The real market cap math, the real ATH distance math, the real multiple required math. And when you do it properly, the asymmetry between these two assets at today's prices is more significant than most people have ever actually calculated. So let us do it properly. XRP at the time of recording is approximately $1.08 to $1.10. Market cap, approximately $67 billion. Circulating supply, $62.47 billion. XRP's all-time high was $3.84 in January 2025. The ATH represented a market cap of approximately $224 billion at that circulating supply. XRP is currently trading at roughly 30% of its previous all-time high price. XLM at the time of recording is approximately 18 to 19 cents. Market cap approximately $6.2 billion. Circulating supply approximately $34.1 billion. XLM's all-time high was 94 cents, representing a market cap of approximately $32 billion at that supply level. XLM is currently trading at approximately 20% of its previous all-time high price. But more importantly, and this is the number that actually determines gains per dollar, XLM's current market cap is $6.2 billion versus its ATH market cap of $32 billion. That is a 5.2 times return just to reach its previous ATH market cap. XRP at $67 billion versus its ATH of $224 billion is a 3.3 times return to reach its previous ATH market cap. Same dollar, same day. XLM gives you 5.2 times to reach its ATH market cap. XRP gives you 3.3 times. That gap, 1.9 times difference in the returned ATH, is purely a function of where each asset sits relative to its own history, not a function of which network is better, not a function of which has more institutional validation, a function of which one the market has marked down more severely from its previous peak relative to the market cap it once achieved. Before we continue, if you enjoy this type of content, don't forget to subscribe to my channel. If you're interested in joining my GCRIG arbitrage trading team, leave a comment on this video or send me a direct message on WhatsApp or Telegram using the links in the description. You can also sign up directly using the link below. Now, let's get back to the topic. Now, let me make that concrete in actual dollar terms, because the percentages mean more when you see them in numbers. $1,000 into XRP at $1.10 buys 909 XRP at $3.84. The previous ATH 909 XRP is worth $3,490, a gain of $2,449 from a $1,000 investment, a 249% return. $1,000 into XLM at 18 cents buys 5,556 XLM at 94 cents. The previous ATH, 5,556 XLM, is worth $5,222, a gain of $4,222 from a $1,000 investment, a 422% return. XLM at its previous ATH returns 422%. XRP at its previous ATH returns 249%. XLM gives you 1.7 times more gains per dollar just to reach where each asset has already been. And this is before accounting for the fact that XLM's all-time high of 94 cents was achieved in 2018 when Stellar had a fraction of its current institutional deployment, no DTCC integration, no Clearstream custody, no $3 billion in real-world assets on the network, no Bitwise ETF inclusion, and no UNDP partnership running in 17 countries. If XLM's previous peak was achieved with materially less infrastructure than it has today, the argument that it can only reach its previous ATH and not exceed it is a conservative assumption rather than the base case. XRP's all-time high of $3.84 was achieved in January 2025, 15 months ago from the time of recording. That peak came from a specific, identifiable combination of post-SEC lawsuit relief, Trump election euphoria in the crypto space, and a surge of retail attention that coincided with a favorable macro environment. Those conditions do not repeat on a calendar schedule. They require new catalysts of comparable magnitude to produce a new ATH. XRP and a new ATH requires the market to give it a market cap that is higher than $224 billion, which means XRP needs to be worth more than it has ever been worth at any point in its history. That is possible. It is not the path of least resistance. XLM reaching its previous ATH of 94 cents requires the market to give it a $32 billion market cap, which it has already done once in 2018 with less infrastructure than it has today. The path back to a previously achieved market cap is structurally easier than the path to a new all-time high. That distinction matters for gains per dollar. XLM is further from an already achieved market cap. XRP is further from a previously achieved price, but the market cap required to get there was unprecedented when it happened and is not guaranteed to be easily exceeded. Now, the Bitwise ETF edition, because it's the most significant market structure development for XLM in recent weeks, and it connects directly to the gains per dollar argument in the way that the market has not yet priced. Bitwise rebalanced the Bitwise 10 Crypto Index ETF in July 2026 and added XLM. Replacing Avalanche and Polkadot, the Bitwise 10 holds the top 10 crypto assets with market cap with quarterly rebalancing. XLM replacing Avalanche and Polkadot is not a minor adjustment. It's a statement that XLM's market cap and institutional credibility now place it above two previously well-regarded assets in the index construction methodology. I want to be specific about what index rebalancing means for an asset's price mechanics, because most people read ETF inclusion news as a sentiment signal and miss the structural demand signal underneath it. When Bitwise removes Avalanche and Polkadot from the index, the ETF sells those assets. When Bitwise adds XLM, the ETF buys XLM. Every unit of the Bitwise 10 ETF that exists needs to purchase a proportional allocation to XLM to reflect the new index composition. And going forward, every new dollar that flows into the Bitwise 10 buys a proportional slice of XLM automatically, without any investor in the ETF making an active decision to buy XLM. Specifically, they buy the ETF buys XLM on their behalf. That's passive demand that doesn't require anyone to form a view on. XLM's individual merits. It just flows in proportion to whatever AUM the Bitwise 10 attracts. Assets that get added to passive index ETFs experience a structural, ongoing, non-discretionary demand stream that doesn't exist for assets outside the index. The magnitude depends on the AUM of the product. The Bitwise 10 is not the largest ETF in the world. It's not BlackRock's IBIT, but it is a regulated, institutionally accessible, SEC-registered product whose AUM grows as crypto allocation by institutional and retail investors through ETF wrappers. Grows. So every new percent of AUM added to the Bitwise 10 creates proportional XLM purchases automatically, and the gains per dollar math for XLM is starting from a base where that structural demand stream was not present before the pack. July rebalance. The Bitwise inclusion is not priced in. The market shrugged. Now, combine the Bitwise addition with the T. Rowe Price active crypto ETF that received SEC approval with XLM on the forced eligible asset list. T. Rowe Price is an active fund, an active portfolio management team making deliberate, ongoing allocation decisions. They have the mandate to hold XLM. Unlike the Bitwise passive product, the T. Rowe Price Fund can overweight XLM relative to its market cap weight if the portfolio team believes it's undervalued. Two ETF structures, one passive, one active, creating two different types of institutional demand for XLM simultaneously. And the market, at the time of recording, is pricing XLM at 18 cents to 19 cents. $6.2 billion market cap. Fifth consecutive week of net selling pressure in the broader market. Fear index at 23 cents. The gains per dollar argument does not require you to believe XLM is a better asset than XRP. It does not require you to dismiss XRP's institutional payment corridor story. Its 9 consecutive weeks of ETF inflows, its Flutterwave equity stake, its MECA CAA CSP license in Luxembourg, its Clarity Act tailwind, all of that is real. All of that matters for XRP's long-term position. The gains per dollar argument is narrower and more specific than that. It's asking one question and one question only. Given where both assets are priced today, which one returns more for each dollar you invest to reach a specific scenario price? And the math gives a clear answer at every relevant scenario you can construct. Let me run one more scenario, not the ATH scenario, a forward scenario, because I want to show the asymmetry holds at price levels that go beyond previous peaks rather than just returning to them. Suppose both XRP and XLM double their previous all-time high market caps in this cycle. For XRP, that's a market cap of $448 billion. Roughly equivalent to Ethereum at its peak, not unprecedented for a major crypto asset in a bull market. At $448 billion market cap, XRP trades at approximately $7.18. $1,000 into XRP today at $1.10 returns $6,526, a gain of 553%, $4,526 from a $1,000 investment, a 553% return. For XLM, double its previous LTH of market cap is $64 billion, which would require XLM to trade at approximately $1.87, and $1,000 into XLM today at 18 cents returns $10,389, a 939% return. Same scenario, both assets double their previous ATH. Market cap, XLM returns 939%, XRP returns 553%. XLM gives you 1.7 times more gains per dollar, even in a scenario where both assets are assumed to achieve the same relative performance measured against their own history. The asymmetry is structural. It does not depend on XLM outperforming XRP in any qualitative sense. It depends only on where each asset starts relative to where it has already been and where a reasonable scenario takes both of them. Now, the honest counter argument, because this video is not complete without it, the reason XRP commands a $67 billion market cap while XLM commands only $6.2 billion is not arbitrary. XRP has more institutional recognition, more regulatory clarity, more payment corridor volume, more ETF inflows, more analyst coverage, more retail awareness, more liquidity, more daily trading volume. The market is pricing XRP at a premium to XLM for reasons that are grounded in the difference between the two assets. Current institutional traction. An XRP holder who converts their entire position to XLM because the gains per dollar math shows XLM has more upside. Percentage is taking on incremental risk in exchange for that incremental upside. XLM's path to realizing its ATH market cap is not guaranteed. It depends on the DTCC integration generating visible on-chain data demands. It depends on the Bitwise and T-Rowe price ETFs attracting inflows. It depends on the UND partnership and the broader multilateral development bank adoption curve playing out on a timeline that produces price impact in this cycle rather than the next one. The gains per dollar asymmetry is real. The risks that explain the asymmetry are also real. Holding both assets, as the title of this video suggests, is not just a hedge. It is a way of capturing the gains per dollar advantage of XLM, while the institutional payment corridor story and the ETF inflow story continue compounding in XRP. The double play is not about choosing one over the other. It is about understanding that the asymmetry exists, sizing each position to reflect the different risk profiles, and letting both assets do what they are each doing simultaneously rather than forcing a choice that the math does not require. The Genius Act regulatory implementation lands on July 18th, 4 days from the time of recording. That is the next near-term regulatory milestone that affects both assets directly. Ripple's MECA CASP license across 30 European Economic Area countries is already in place. XLM's commodity designation from earlier in 2026 is already in place. The regulatory tailwinds are blowing in the same direction for both assets at the same time. The question is, which one the market reprices faster when the next recognition event arrives? So here's the question to close on. Given the math in this video, XLM returning 1.7 times more per dollar than XRP at every scenario price we modeled. If you could only add to one position today, which one and why not which one you already hold? Not which one you feel more attached to. Which one would you add to right now with fresh capital, knowing everything this video just showed you? Because the answer to that question reveals whether the gains per dollar math changed anything about how you think about this pair, or whether you walked in with a preference and the math did not move. Either answer is useful, but the honest answer tells you something important about how you're actually making decisions. Drop it in the comments, XRP or XLM, to add to today, and the specific reason, not the general thesis. If running the actual market cap math changed how you see this pair, rather than just confirming what you already believed, hit the like button. It is how this kind of specific numerical analysis reaches people who are making portfolio decisions based on narrative rather than multiples. Subscribe if you want the analysis that does the math every time, rather than describing the story, and share this with whoever in your life holds one of these two and has never actually calculated what their gains per dollar look like across different scenario prices. The math is not the whole story, but it is the part of the story that most people skim. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience. Arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.